Discounted valuations for self-directed IRA Roth conversions. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. Welcome to another episode of Adam Talks. Today's episode, how investing in alternative assets using what's called the discounted valuation strategy can save you a bundle of money when converting to Roth. So what I'm going to do in today's podcast, I'm going to spend about 8 or 10 minutes going through this topic. It's quite complex, advanced topic, but I want to introduce the whole idea of discounted valuation. And the reason discounted valuation is so attractive to Roth conversions is that you can use a discounted valuation to reduce the tax you owe on a Roth conversion. And the premise for this is the family limited partnership context, okay, FLP. Discounted valuations have been used for 70, 80 years in the family limited partnership context. So what a family limited partnership is it's essentially an estate planning tool that allows family members to transfer assets at reduced values through valuation discounts. And they involve trusts and estate planning. But this concept has existed and lived in the family partnership setting for many, many years. So thinking of what a discounted valuation means, it means that the amount of assets you're transferred, the tax on that will be reduced because the value you're actually transferring isn't really worth what you would think it would be worth. And there's reasons why you can get a discounted valuation, okay? So why is that important in the Roth conversion context? Well, you pay tax, ordinary income tax, on the value of the Roth conversion. So when you convert a pre-tax IRA or pre-tax 401k to Roth, you pay tax on the fair market value of the asset or cash. So if you're converting $100,000, you're going to pay ordinary income tax on $100,000. Your tax rate is going to be based off other income throughout the year that you aggregate on your 1040, and then you add all that ordinary income and other income together, and that tells you your tax rate based off that number. Now, there's no 10% early distribution penalty for Roth conversions. So if you're doing a Roth conversion at age 25 or 65, it's just tax, but it's ordinary income tax. It's not capital gains tax. The highest ordinary income tax bracket in 2024 is 37%. Once you're around 650,000, married follow jointly. But the brackets, start moving up, pretty quickly. So when you do a Roth conversion, that amount gets added to your W-2, your other earned income, or other passive income, and that will dictate the amount of tax. So getting a discounted valuation obviously is super interesting because it's going to reduce the actual amount you're converting. And once it's in a Roth, this is the huge tax play, is once you're 59 and a half and the Roth's been open at least 5 years, you can pull the money out of the Roth IRA or 401k tax free. Okay, so that's huge because if you're able to take a pre-tax IRA asset that if you took a distribution of, you would pay ordinary income tax on. So let's say you're 65 and you have $200,000 in real estate and you want to live in that property, you'd have to pay ordinary income tax on that $200K. But if there's a way that 10 years ago, you were able to, or 5 years ago, you were able to get a discounted valuation of maybe instead of 200, maybe 130, 120, pay tax on that. And now 10 years later, you can just move into that property tax-free or sell it, put it in the Roth IRA and just literally take the cash and live off it tax-free. It's a huge, huge, huge savings. So the family limited partnership setting gives us the foundation and premise behind using the discounted valuation strategy for Roth conversions. And there's really two ways to get a discounted valuation for a Roth asset. One is a lack of marketability discount, and the other is lack of control. So lack of marketability essentially is used specifically in alternative assets, so non-tradable assets, non-stocks, non-equities, non-mutual funds, non-ETFs, non-cryptos or gold, right? An asset that doesn't have a marketable, ascertainable value. Something like a private equity interest or a hedge fund interest or a venture capital interest or real estate or land or investment in a private business, which is generally the most common, right? You can't just sell your interest in the neighborhood pizzeria in a second, right? You can't sell it like you're selling Apple stock or Tesla stock or mutual fund A or Bitcoin or gold, because you got to find a buyer, you got to agree on the price, you got to do the whole purchase agreement. So that is what is designated as lack of marketability. You can't just sell it and market it quickly. So if you're going to value your interest in the pizzeria, an appraiser would probably give you a 20, 30, 40% discount on the value, because even though you paid 100K, and even though the pizzeria makes great pizza and it's a nice business investment, it actually isn't worth what you think it's worth. Because if the world was coming to an end and you have to sell it, you're not going to get what the actual fair market value is. And then there's lack of control, which happens when you're investing, let's say, in a private equity fund or a venture capital fund or a business where you don't own 50% or more, or you actually have no controlling interest, meaning you're not the manager, you're not the executive, you're a passive investor. And again, world's coming to an end, and you have to sell your 20% stake in the cafeteria, the cafe, the restaurant, the car dealership. That's not worth as much as if you controlled it, right? If you own 70% or 80% or 51%, because you don't have actual control. So you just along for the ride, you're a passive investor, meaning an appraisal would give you, under the right circumstances, a lack of control discount. And I'll go through some interesting case laws, okay, that I think highlight how this works. So there's a case, the state of Kelly, versus the commissioner. Most of these cases are family limited partnerships. You're not going to find many, or any, Roth conversion, discounted valuation cases. Now, I've done, I don't want to say thousands, but close to that over the last 15 years. And again, they follow the family limited partnership. We've worked with a number of appraiser companies that can help you in this regard. But in this case, the tax court allowed significant lack of marketability and lack of control discounts when valuing the interest in an FLP. The court noted that limited partners had little to no control over the partnership and cannot easily sell their interest, justifying the use of both discounts. The court applied a 40% combined discount. Then there's another case, Estate versus Giustina versus Commissioners, 2011 case. In this case, the tax court allowed a 35% discount. Went to appeals, and it was reduced to 25%, reflecting a lower lack of control discount. Again, this was a family-owned timber company. Next case, the state of Jones v. Commissioner. It's a 2019 case. This case involved a family limited partnership that held marketable securities. This is interesting. The IRS argued that the discount should be limited because of the highly liquid nature of the underlying asset. However, the court allowed a 30% combined discount, emphasizing that even liquid assets can justify valuation discounts due to lack of control. So, right, if you own 100% of your IRA through an LLC or just direct, and you own Tesla stock, you're not going to get a lack of control or marketable discount. You're probably not going to get any. But if you're in the alternative asset space, and that's why the lack of marketability discount works so well in alternative assets, and let's say you own a hedge fund that is buying and selling stocks or options, or you own a real estate fund, or you own a minority interest in a company or a real estate deal, that's where you can get lack of marketability and lack of control. And I've seen, conservative 25 and up to 50%. There's an IRS revenue ruling 93-12. And in this ruling, the IRS essentially accepted the concept that a lack of control discount could apply even if all the ownership interests were held within a family. So even though the whole family controls the entity, this family limited partnership, so it's Adam, my spouse, my kids, you can still get a lack of control or marketability discount, even though the family controls it. So again, more evidence supporting the whole concept of valuation discounts. So the family limited partnership setting is helpful to using that to apply it to the Roth conversion setting. It's best used in alternative assets, because if you just have a brokerage account and you control it and you're buying and selling stocks, mutual funds, or ETFs, you're not going to be able to get a lack of control of marketability. You generally need an investment fund, a trust, a setting where there's either alternative assets that are not readily transferable or marketable, plus you're invested into an investment fund that you don't control. Private equity, hedge fund, real estate fund, investment fund, even a family fund, even a situation where it's maybe a bunch of different IRAs. It could be my wife's IRA, my kid's IRA. This revenue ruling offers support 93-12 that even though the families control it, if that IRA owns less than 50% or doesn't have the actual control, you can still get lack of marketability, lack of control, and get a discount of 25 to 50%. Again, IRA Financial has the expertise and knowledge to do this. We've helped hundreds and hundreds of clients over the years do it. We'll help you gauge whether it's an option and then put you in touch with the valuation firm that can help. It's not super expensive. You don't have to hire like an E&Y. There's local firms, appraiser firms we work with, and they can assist you. We'll do all the IRS filings, the 1099-R, help you report it. You put it on your tax return, and we would work with your accountant to make sure that gets done. And then you'd have supporting evidence of an opinion letter, which would protect you against penalties, assumingly the IRS accepts it. The good news is you're not just kind of taking this concept and just de novo doing it. The family limited partnership context gives the support for getting discounted valuation, along with case law and revenue rulings from the IRS supporting this. So wanted to introduce the concept. It's quite complicated. It's quite advanced. So I tried to keep this under 10 minutes. I'm not here trying to be a law professor, but I'm just here educating people, issue spotting, and letting you know that if there is an opportunity, you have a pre-tax IRA or 401k, you have alternative assets, you want to do a Roth conversion because you think the asset will appreciate in value in the future. You want to shelter all that appreciation and gains income from taxation. So long as you're over 59.5 and the Roth's been open 5 years, the discounted valuation will allow you to do it, allow you to hopefully take advantage and shelter all the future appreciation and gains from taxation, gain the flexibility, still invest in alternative assets. Obviously, you need to make sure you can afford the tax, right? Even though you get a discounted valuation, it's still income tax owed on that asset. You obviously, the younger you are, the better it is probably. And there's a lot of different items to consider, which is what we will do with if you're a client or you're a new client or you want to be a client. That's something that our team will help you do and work with you to make sure that you understand the rules and make sure you have everything you need to consider before deciding if you want to do a Roth conversion. And then on top of that, whether you want to get a discounted valuation. So thanks for listening and for watching on YouTube. I really appreciate it. Please, if you don't mind, give it a 5-star. The higher rated you give me, the more the algorithms, those crazy algorithms will pump the podcast across the platform so more people can listen to it, or on YouTube more people can watch it, which is the name of the game, because this is an educational podcast that is here to educate and hopefully identify very interesting tax concepts, especially in this case in the self-directed IRA space, that could end up saving you a lot of money and sheltering a lot of income from tax, which as a tax lawyer is the ultimate goal. So thanks again. Have a great day, and I'll see everyone again next week.